thank you everybody for coming. And you know, we're gonna, rather than a lot of announcements and everything else, we've just got some really big news on the mark. And I think you're gonna be really impressed. It's something I'm sure 99% of you have never heard of. And it really, really spikes the returns. So this is more, A, it's a little more educational. B, we're also filming this as our new investment presentation for the mark. So that's what'll be the presentation for that part of it. So we're gonna go over this in detail. So this is a lot more numbers and a lot more understanding the underwriting and things like that.
K1. So is everybody aware that their K1s are now uploaded? Raise your hand if you weren't. See, we even have, so good, good. Okay.
Pay attention back there.
For those of you who have small discrepancies in your K1, and I mean by, like, maybe your name is off by one letter or maybe even two, okay? Don't fear. The IRS won't flip out as long as your social security number is correct and your, most of the information is correct. It's good. I got better things to do than to deal with you guys telling me that I left off an E on your last name, okay? So if it's completely different, call me. For those in Frankfurt Station, we got the partner loan, okay? Those were 1099s, not K1s. They are not on the portal, and those were mailed via snail mail. And you know how reliable they are, about 70% of the time. So if you, I'm already hearing that people have received them, but if you have not received them, definitely call me, okay, or Garrett. So I wanted to make sure that everybody knew that.
K3s, they're for foreign individuals and companies, or if you've got a lot of foreign income, so outside of the United States.
If I have a foreign income from India, would I have to file K3?
No, you received K1s and K3s from us. So that way, if you have to file foreign, the K3 is what you use for that. Am I right on that? Thank you. It's not something we ever deal with, but there were questions on that, and quite honestly, I didn't know either. So we did that. Iron Ranch. Who's an Iron Ranch? Okay. Iron Ranch is, we are in value engineering stages, which means we got all our drawings done, everything's going great, we get bids, and then we just about fall over because the bids are too high. So then we go back to value engineering, meaning we're looking at that, okay, do we need full brick wall right here? We can take that part out and do something different, all different things to save us money on the construction side. So that's where we are right now. We should have those numbers, and we're looking at a groundbreaking mid-April. We're a little behind schedule because of all the engineering and things we had to do with that, but that one's going great. We've got, what, 6 million in out of 8 or 9?
More than that, we're a little over 7 million.
Little over 7 million, okay. Okay, subscribe to getting the funds in. Okay, there's a couple of people I told they can squeeze in for a little bit. So we'll talk about that. Okay. Yes. Okay, let's talk, turn on your microphone.
Okay.
Okay, let's talk about investor relations for a minute.
Okay.
So real quick, do you know how many partners we have? About 1,000 active partners. Okay, so if he were to get a call and just spent 1 minute with everybody, there's 1,000 minutes right there. Okay, so he doesn't have time for a lot of that. That's why he was saying on the K1s, your name's off, it doesn't really matter. It's the social security number they're looking at. The other part they don't even care about.
Okay.
But as far as timing, and then also if you're going to subscribe to something and you want to be in on it, please don't have them have to chase you down. It's an opportunity for you. You know, I'm not trying to say we're, you know, we're so special that you have to, you know, jump through hoops. But if you are committing, then let's go ahead and do that. That way they don't have to spend a bunch of money. They feel like they're bill collectors and calling, hey, you're gonna get money in, things like that. So what other challenges do you have?
Well, so we'll roll something out and you get excited, and I understand we all get excited. And then Julian, by text, call, or email, I'm in, put me down for X. A couple of days go by, no paperwork. A couple of weeks go by, no paperwork. Month goes by, no paperwork. You'll get a reminder from Garrett or myself. Oh, that's right. I'm sorry. I'll get you the paperwork. A couple of days go by, a couple of weeks go by, a month goes by. And so what happens is usually about 10 days prior to closing, the bank wants to see that all the money's in the bank.
Yeah.
The lender does. And so now it's critical. And I'm not saying everybody, but a lot of people will be taking their money out of investment accounts, and therefore they're going to lose a little bit of interest. And they want to hold out to the very end, you know, gain that extra 50 cents for that. It's maddening for us time wise. So please, just if you're subscribed, fill out your paperwork, get it in, and get us your funds. That's all I ask for. I'm simple. Don't ask for much. That's it.
That's it.
That's it.
Okay, cool. Again, welcome everybody. We had a fun event that we did on the 1st. Anybody hear about that? Yeah, and yeah, Reinhard and a couple of people raised their hand. We did an event where we brought in a bunch of athletes and then a bunch of our partners so they can spend one-on-one time together and either go drive NASCAR. This is Jesse, and he's a professional NASCAR driver, so we got to go out with him on that. We had a professional golfer. We had Gracie, who's she's an ambassador for the, what's coming to Frisco? Country Music Awards, no, ACMs, American Country Music. And so she's an ambassador there. She came and sang. We had professional athletes. We had the Olympians, football players, everything. So it was a really fun event with everybody that came. And I mean, you guys have met Kevin, but geez, I was the shortest guy there. So not fun. So let's talk about the mark real quick here, just as a, who has not seen the mark? Anything about it? Okay. It's a property built in 2021 and then leased up, and the sellers, they build and then they hold. Last January, they were offered $317,000 a unit for this property. And they turned it down. And then what happened? Interest rates went up, values went down. They have other deals in contract, the other deals they were building, so they needed cash. So they decided to sell a couple properties. By the way, the best sellers I have ever dealt with. Absolutely the best sellers we've ever dealt with. And they were realistic on their price. And we put it under contract at $215,000 a unit. Okay, so 30% discount, not too bad, right? Okay, and a beautiful, beautiful property. The leasing agents like to say that this was designed by a woman and her sons. And mainly the important part is the woman part, because little things that you don't catch that make it a home. There's a bunch of little things that are involved, very detail oriented on everything. Absolutely beautiful resort style pool. And this was in the PPM. What I do, for those of you who don't know, is I put together and say, here's, if you invest, and if you invest $100,000, this is what it looks like. Year one, $545. Not going to retire on that year one. Year two, $2,500. Year three, $3,974 in cash flow plus $10,000 in refinance proceeds. Then $4,100 or 4.2, and then selling it. And the overall per year average return over 5 years is projected at 17%. That's the way that we analyze properties is if it's a 17% return to the 16% or higher to the partners, then we look closer at it. Okay, and so that's where we were as far as this deal. Okay, here was the breakdown. Paying $76,750. Here's per unit, $216 per unit, plus all our closing costs, et cetera, et cetera, et cetera. And then the year 5 value, $107 million. Year 5 value, $302,000 per unit. So still $15,000 less than what they were offered last year. But that's how markets change. Okay. Now I want to show you what we do on this. Underwriting. The way that we do this is an investment presentation that we put into the private placement memorandum. Something that we do that's a little bit different. We show you all the numbers and how we got there. And there's a few things that if you change a little bit, will have a drastic effect on the overall returns. And that's one of the things that I really want to make sure you understand. Make that bigger. So we're paying $76,750. We'll have $49 million first loan. By the way, this is all changing. So $10 million in pref equity. Here's the whole thing. The market appraisal was $83 million. So we had built-in equity day one. I mean, we're all in at 80, but $3 million in equity. So a great deal there. We plugged in our debt. We look at those items. Then we go over and look at what the current rents are, what the current rent schedule is. And then this is where it goes a little bit more from a little bit of art, a little bit of science. What can we do with the rents? We look at the whole market, say, where can we increase rents and what can we realistically get to? So this equates to a 4.23% rent increase over what the current rents are for the next 12 months. So 4.5%. DFW is still projected at having over 5% rent growth, even with this economy, because Texas is doing great. Nationally, I think it's 3%. Anybody know that off the top of their head? So we go ahead and plug in what we think the rents are. So we was raising at 4.2%. We then go in and analyze the financials. So we put in there, what's the market rent and what is the current owner doing, income and expense. And then we take that out and do a sponsor performance of best case and worst case. And we run those numbers. I want to show you something right here. Property taxes, $1,350,000. Okay, little error here, but that's okay. It does. These numbers don't mean anything, so it's not part of the thing. $1,350,000 for property taxes. Okay, $4 million net operating income, company expenses, reserves, debt service. So cash flow is $1 million, $1,047,000. So this sponsor performa then carries over, and we go out 5 years. Okay. Then we take that same thing, and you look right here. So we've got vacancy loss is 7%, collection loss year 1 3%, and then 1% thereafter. Income increase 5.5, 5, 4.5, 4. Expense increase 3, 2.5, 2. And so that just gets extrapolated right on out. Okay, nothing very, very mysterious about all that. But then you go to the part everybody likes, is we take the year 3 net operating income and divide that by a cap rate. Here we used 4.5% on the cap rate because it's a new property, it's a nice new property, and we're going out 3 years. Interest rates go up, and in about 18 months they start coming down a little bit, and that's what it's been historically. We plugged in a 60% refi, which is actually very conservative and it's either a supplemental or a refinance. We just call it a refinance, where we get extra cash, but we pull cash out. So we pay off the pref, and then we have proceeds of $2.7 million. Then we go out 5 years, say, what's the cap rate? 5%. What's the value? Our costs, pay off the loan, and the proceeds. Okay? All that's pretty simple, right? Get a little more complex on this page. That cash flow gets carried over here. The cash flow, the refi proceeds, and the total proceeds from the previous page. But we've got preferred equity on this one. So what happens? They get paid first, right? Okay. So now we say that we got to pay, we're accruing 13% with preferred equity. So this is we have very low loan limits right now. Fannie, Freddie, et cetera, it's 60, 65% loan to cost, which is extremely low. It means we would need a whole lot of equity. And the more equity, more cash you put into a deal, the more it lowers the overall yield, okay? So we wanted to limit that. So we went to private equity to get a little bit more debt. 13% is what they accrue. They earn that every year. And current pay is how much we're actually paying on it each year, okay? So current pay is 6%. So if you notice, our starting balance was 10 million. After accruing 1.3 and paying 600, now we're at 10.7 million. So you can see that goes on up. But in our year 3 refinance, we pay it off. Now we don't have that anymore. And so the cash flow comes down here. This is the property level cash flow along with the refinance and the sales proceeds. And then this is that other shot that I showed you. For a $100,000 investor, what do they do? What does it look like? Okay, follow all that? Because now I'm going to show you something amazing. 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 Okay, we're at a 17% return. Remember that. What the hell? 17% per year average annual return, okay? You see that there? It's also on the back page. That's how we come up with what the partner's return is. Is 17% good?
Yes.
Wow.
Yes.
What are you getting now? 4? Okay. Okay, 17% is great. We've always projected 17. What have we been hitting? For those of you who've partnered with us. Yeah, 30 to 40% on average. Yeah. And so we go in conservatively and beat that. What would happen if we could get rid of property taxes? Okay. What's the return now? Okay. That's just because of property taxes. Can we get rid of property taxes? Altogether?
Yes.
If you fight hard enough, get rid of them altogether? Who do you have to fight to get rid of them? Yeah, well, okay. So what we did is, this is a great thing. That same seller I was talking about, they had 2 properties, one in Denton and one in Weatherford. We wanted actually the one in Denton a little bit more. But an entity that is a PFC, okay, Public Facilities Corporation, was buying that property. And they had a lot more cash, a lot better deal. So they went with them, the sellers went with them to buy that one, and we got to buy Weatherford. Well, they never heard of a PFC, Public Facilities Corporation. Has anybody else heard of that? Okay. A Public Facilities Corporation, it's not a nonprofit, but it's a public company. So it's like Weatherford Housing, okay? So you go to that housing department and you donate your building to them, okay? Okay, don't freak out yet. There's no reason to freak out anyway. You donate the building to it and then they give you a 99-year lease back. And in this equation, the lease payment's $150,000 a year. Okay, so we save $1,350,000, and then we pay $150,000. Is that a good deal? Yeah. Okay. The only negative part about that, for those of you who are in there, Victoria, you know what it is? We don't own the building. No depreciation. That's the worst part of it. And there's no depreciation or bonus depreciation. So that's the negative of the whole thing. But we buy the property, we donate it back to them, they lease it back to us for 99 years, but we can also cancel that contract after 15 years. Okay? But why would you do that if you're getting free, paying no property taxes? Okay. Now, so that's what Denton was doing. They were doing this PFC. Well, the sellers said, well, let's go ahead and take a look at that and see if we can do it on the Weatherford property. So they started going through that process of putting it into this PFC structure. And they said, well, we really wish you weren't buying the property because we can go ahead and do this. Okay. Who remembers cap rates? Okay. A 5% cap rate would make $1 of savings worth how much? 20 bucks, okay? $1 divided by 0.05 is 20, okay? So every $1 you save in expenses adds $20 in value to your property. If we're saving $1 million, what did that just increase the value of the property to? By $20 million. So they basically said, look, we wish you wouldn't buy this. But they still do need the money and things like that. So they're going through this process, learning about this PFC themselves. And they basically said, look, if you want to do this PFC, we'll help you do it. We'll give you plenty of time to do it. They're lawyers. They're helping us push through the process to go ahead and get this done. They've also said, you can have whatever time you need to get it done. We're going to go through and do this. All we ask is that you give us $2.5 million extra on the purchase price. Is that a good deal? Yes. Yeah. Pay them an extra 2.5 and get $20 million in value, right? Okay. So now we're going to start jacking with this spreadsheet so that you can see. Shoot. Okay. So, first thing we've got to do, we already took the taxes out, it's 39.6. Okay. If I said I've got an investment that's going to pay you 39.6, if somebody said they have an investment that's going to pay 39.6%, full of crap, exactly. There's no way. Okay, so what we're doing here is changing this. So plus 2,500,000. It'd be better if I could actually do this. I'm sorry, this is a different computer. 750 plus $2.5 million. So now our new price is $79,250. Still $223 a door. Okay. There's legal fees, there's higher costs, everything else. So we're going to raise this to $4 million, our closing costs, because there's a lot more expense to it. Still a good deal, right? Okay. Now look at, we're at 31.5. Operating, we're going to put an extra $300,000 just in case we have any unknown expenses. Here's the other thing. Banks and investors love these PFCs, okay? So they'll get more aggressive on their lending. So this is now a $57 million loan, okay? Returns now, with the higher loan amount, it reduced our capital needs. What happened to the return? Okay, if I said 49.5%, who's going to say I'm completely full of crap? Everybody, okay? Watch this, pref equity. By the way, this pref equity will go to 15 million. What do you think that's going to do to the returns? Who thinks they'll go down? Who thinks they'll go up? Okay. Okay. Yep, that is because of Private equity makes good deals better, bad deals worse, because you got to pay them first. So we're only budgeting in here $10 million right now. Okay, so we'll raise $17,350,000. We're all in at $45 million. Oh, crud. God, I hate regular computers. I did. I escape and it's not. Where's the undo? Control D is Control Z. Thank you. I'm used to a Mac. Okay. Now, we're going to be all in at $84 million, but our new value is going to be what? 100 million. Okay. Take a look at this. Okay. $100 million. So that gives us how much in equity right now? 84 million minus the $100 million, so roughly $16 million. How much are we investing? So on paper, you already have a 2x return. On paper. Okay, do you follow that? This is insane. We've got $20 million, $16 million in additional equity, and we're putting $17 million down. You already on paper doubled your money. Day one, doubled your money. Just on paper though. It's just on paper, anything could happen with it. Something that we did do is also a lot more work and a lot more costs, et cetera. So we did bump our acquisition fee up, but it's also already in our closing costs. Now our debt, anybody seen anything happen to banks the last couple days?
What banks?
Yeah, really? Okay. There's now ripples in the water. And so lenders, what they do is they increase their spread on their loan. Okay. The way that commercial debt works is they have an index. Could be SOFR, 10-year treasuries, whatever it is. We base ours off a 10-year treasury. That's the index. And then the lender puts a spread on top of that. Okay. We've been waiting to rate lock or to lock that spread because we don't know what the market's doing. So we want to be very careful on what we're doing on that. However, lenders just bumped up that spread by a quarter point. And we already had the ability to lock our spread. So we went ahead and locked our spread today at a lower rate. So that spread over the treasuries is lower than you would go get right now. Like right now, this is 5.37 as of today. Okay. Which is good, but we're not going to put this in our PPM. We're going to do more like 5.75. Okay. Now, who's invested in other deals with floating rate debt? How's that doing? Anybody getting cash calls? Not yet? I know a lot of people that are getting cash calls. One of them, they just recently bought it, $100,000 investor, 25% cash call, just to pay for the cap rate insurance. That's a sunk cost. It's gone. You don't get any of that back. So I have always been a firm believer in fixed rate debt. The last 10 years, everybody said I was an idiot. And I'm like, I've been through down markets. I know what this looks like. We got to have fixed rate debt. I didn't know it was going to take 12 years before I actually looked like I'm doing something good. But we try to minimize risk rather than maximize profit. And in doing that, it costs us a little bit more on a sale because of defeasance, but we're protected from the downside risk of the rates going up. Follow that? In this equation, it's the same scenario. Rates could very possibly over the next 5 years go down. So it might make sense to have a floating rate mortgage right now, right? Who would do a floater right now? Who would do fixed right now? and the rest of you don't know what you do. Okay. So fixed rate. The problem with fixed rate is that defeasance, if you sell it, you've got to pay a lot more. So what we did is we're paying an extra 16 basis points, I think it is, to have a flexible prepayment penalty. So after, I don't know if we're going to do 5 years, after 5 years, no defeasance. That's huge. Okay. You don't realize how huge that is. We sold Brookside Apartments, $22 million loan, $5 million prepayment penalty. We still did real well on that. The overall return, what was that? Do you know off the top of your head? 16% overall? Annual rate of return. Would have been better if we would have had a floating rate, but if we would have been caught with our pants down like people are now, would have been hurt. I'm going to go ahead and say 6% on this supplemental. Now, the reason the PFC, this Public Facilities Corporation, does this is because they want affordable housing. So we have to allow, out of our 355 units, we have to allow 20 units as HUD units, Section 8. Okay, that's 20 units out of 355. Then half of the property, 50%, right, has to be 80% AMI. Okay, what that means is average monthly income. We can only rent to people that make 80% or lower than the average monthly income. But where do you get the average monthly income? Okay. Well, they're basing it on Tarrant County. Tarrant County or Fort Worth? Tarrant County. What do you think has a higher average? A whole MSA. Okay, the whole MSA. Do you think Dallas and Fort Worth and Denton combined have a higher overall average income than Weatherford? Yes. Okay, so we looked at this as an analysis and said, look, most of our residents that are there are already making 80% of AMI or under, so it doesn't really affect us. Follow? So there's a lot more reporting we need to do and hoops we've got to jump through for compliance. Exactly. So I said, let's do this. Rather than a 4.23% rental increase, let's just assume, okay, on a PC is still Control C for copy? Is Control V still to paste? Okay. Control V. Okay, so now 0, not raising the rents at all right now, year 1. Okay, what does that do to the return? It's still at 38.7. Okay, so let's be even more conservative. And let's take our rent increases and let's lower those to 3%. Here, if you're ever underwriting a property and you want to be safe, some people say use the same exit cap rate as the going in cap rate. The only way to do that is keep your income and expense at like a 3 and 2% increase, because you can't have both, can't have your cake and eat it too. You can't say that we're going to have a lower cap rate or a same cap rate if you're also raising the income. It's like a debit and a credit, you know, you've got to have both. Okay, so let's go down here. Now, if you're buying a property, do you think the cap rate would be higher or lower on a land lease? Yeah, higher. You're not actually buying the land. You're not buying the building, right? So you would think that you would want a higher return. It's only about a 1/4 point, okay? So let's change this. Rather than a 4.5, let's take it all the way up to a 5% exit cap rate. Take this to a 5.5. Okay. Let's do this to a 70%. Okay. So those are some changes now. Now we're going to refinance. Still got to pay off the debt. What is our return now? 18.2 on this particular analysis. Okay. We had some other changes in here that we did. Oh, that was 5.25. Yeah. 5.25 on that exit cap rate. Puts us at a 22.8% average annual return. But you got to remember, we lowered our rental increases to only 3%. We didn't increase the rents year one at all. Okay? We put more money in reserves. What else did we do on this? Oh, let me show you something else. Oh, yeah. Only thing is the pref, when we analyze this, it's not 13 and 6, it's 15 and 2. 15% accrual and 6% current pay. Actually, 8% current pay. Okay, what does that do? 22.2% return. There's a funny thing that we're arguing about right now. Okay, CPA's in here. Property taxes, that $150,000, that's not a lease payment. That's an asset management fee that is charged by the housing authority. Where would an asset management fee normally be on your income statement? Below the line. Okay, so let's take that out and put it below the line. Oh, by the way, I didn't even mention this part. Look right here. I forgot to say, years 1 and 2, year 1, I have an extra $300,000 cushion. Year 2, an extra $150,000. So let's change that to $450,000, $300,000, and $150,000. Oops, there you go. Thank you.
So you still have that 150,000 above the line?
Yep, we'll change that. 150. I'm sorry, I'm a little slow doing this right here. I didn't want to just show you this. I wanted to show you the changes. Okay. So now we've got to take out our payment here. The heck? I tried touching the screen. How about that? Eastern iPad. Okay, so now we've got the property taxes out of there and they're below the line, right? What's our return now? 24.7. Still good? Do you like that? Am I overly conservative?
Hope so.
Seems like it. Not raising rents. Year 1, very minor increase after that. We still have higher expense. We still have all our regular high expenses. The rents didn't increase. And now it's worth $100 million. 2x return day 1. Cash flow went up a little bit. So $1,800 for a $100,000 investor, $1,800 year 1, 36. But the sexy part everybody likes, cash out refi. Who likes cash out refis? And why do we like those? Tax free. No taxes paid on that. You can go reinvest it again in whatever our next deal is. And then 165 for a total of 24% per year. So you invest $100,000, you get $223,000 total back over 5 years. Interesting? What if I said, here's the thing, there's only a few things we can change. Once you get everything nailed down, there's only a few options to change. What if we did $12 million of pref equity? 24.7 is now 27.4 by just getting $2 million more in pref equity. They'll go to 15 million. Yes, sir. What if we move? Then the return's going to go down. So take out pref equity altogether. First thing that's going to happen is our capital raise is going to go to $27 million, which is a lot harder to raise than 12. And our per year average return, I would guess 14. Oh, still 17. What about the cash flow? $3.5, 4.8. Big refinance because we put a lot more down payment. So the cash flow doesn't increase dramatically, but the overall return goes down. So what we're doing here is we're building a business plan for whatever business. This property is just a business. How do we want to set up that business plan to work to make the best return? And then it's also, we're shopping all this. We've got to go. So we've had calls every single day with the lenders, with the private equity. We've even on a call today with somebody who wants to put in common equity. Common equity, they would come in for 90% of our total cash flow. We'd only have to raise $3 million to buy this with one partner that's putting up 90% of the capital. Insane. Absolutely insane. So that's what we're working on this property. So we're actually, because we're doing the PFC, we're not actually buying the land, so we're going to have to change the private placement memorandum. And we're going to have to issue a whole new one. Who's in on this property right now? Okay. We're going to have to change the PPM, completely scrap it, and issue a new private placement memorandum because it's a completely different deal having this PFC. Yes, sir. It's a 99-year lease. So you can, and actually if you go back and look, there's millions of properties in the US that are on long-term land leases. This is very common. North Park Mall is on a land lease. Okay? Rockefeller Center.
Do you not own the land or the building or both?
Don't own the land or the building.
Okay, either.
Either.
But you can cancel after 15 years.
But after 15 years, we can cancel without a penalty.
So how do you cancel before then if you want to sell before the 15 years?
Because the new buyer is going to want to not, what you're doing is you're doing a lease transfer, and lenders will still lend on it. Okay, when it gets down to having 20 years left or something like that, that's when it's a problem regarding getting debt. But at that point in time, first off, that's 79 years from now. Yeah, it won't matter. And anybody that wants to buy it after us, they're going to want to have that no property taxes. Okay, so this is a very normal deal as far as being on a land lease. There's a great book called Empire. It's about the Empire State Building, and an investor from Japan bought it. He paid $5 million for the Empire State Building and went in there trying to do stuff. Leona Helmsley had a master lease on that property for like 99 years. She had complete control of everything. So his return was very small because she had this master lease. In real estate, real quick something, control is more important than ownership. Got to remember that control is more important than ownership. And we've got control on this for 99 years.
So once you donate the property, still you can sell that to us.
You can still sell it. Yep. Completely transferable. Yeah, it's not a problem at all. Not a problem on selling the property at all. We did have it in there that we could cancel it before 15 years, but pay a penalty. Oh, I didn't add something.
And the lease could be transferable to new buyer.
Correct. The only other thing on this is when we sell it, they get a 1-point fee. Okay. So we're still at 23. So it is an incredible deal. We lose out on the depreciation, but we don't pay any property taxes. $1.2 million in savings. Helen. It's still for accredited. Yeah, we're still going to have this for accredited only, accredited investors only, just because the amount of capital we're raising. And we're doing advertising. Has anybody heard us on radio? We're advertising on the radio. Thank you. Advertising on the radio. We're doing advertisements some other places. 660 AM. Yep. Yeah. It's, as Julian was saying, there's in the Texas government, Texas House, they're trying to pass a law getting rid of this availability because it's just too lucrative. Because now, where does your property taxes go? What's the biggest property tax you have? Anybody know? Schools. And who usually lives in apartments? People with kids. Okay, so they don't want, they get all that taken away from them and they have no control over it. Police, school, hospital, city, county, state, everybody gets basically screwed. They don't have to pay any property taxes because the PFC owns it. Yes, sir? No, can't do cost segregation because there's nothing to segregate because we don't own anything. So there's no bonus depreciation, no cost segregation, no depreciation at all, but a whole lot better return. What are my concerns with the PFC model? My first was fear of lying. I'm giving you my property and I don't own it anymore. That's what terrified me. That was my first thing. But it can be canceled after 15 years without a penalty. So I'm not too worried. Even if we had to hold on to it for 15 years, we can still refinance it. We can still, we still have control. We can still do everything we want with it and cancel it after 15 years. But a new buyer could do that too. And that's actually a big benefit on, like on a LURA property, where land use restriction, where you have to have lower rents. They look at the expiration of that saying, okay, that's going to expire now. We can raise the rents dramatically after that expiration. So who knows, 12 years from now, the rents on this property could be way below market. Could be. And so a new buyer would look at that going, okay, I've just got to wait 3 years and I can get rid of this PFC structure. And then I can raise everything way up. So it's a value add if our rents are too low. But the rent, I don't think the rents are going to be too low because they're already under, it's half of the property has to be 80% AMI already. And we already have that. Yes, sir. How often are they calculating it?
Every year, once a year.
Thank you. Yes, sir.
And so when you said we still have control over it, that means there isn't any risk that during that period when it's under the PFC, we can't make certain improvements or other things
No.
that would keep us from realizing that.
No, we've got complete control of the whole thing. It's a 99-year lease and they want us to take care of it. That's the biggest, like I said, in 79 years, that's when it starts to become a problem because people won't want to reinvest money in it, but you can cancel it. So that's where it's stuck because there's properties in Hearst, Euless, Bedford, Hearst, Euless, that they did that. It's called legally existing non-conforming. Anybody live in that city by chance? Okay, there are apartments there that they changed the zoning on. So they're legally existing but non-conforming, meaning that as soon as a certain time frame runs out, they can't be apartments anymore. So there are some of those that the people that owned it, they're not going to put any money into it. I'm not going to put money into it when it's going to run out in a year. And so they just go to crap those last few years because nobody wants to put any money into it. They just bleed them dry, and then that's over, and the city comes and scrapes the buildings. And all you have is the land. So you want to make sure you know what you're buying also, because they were trying to sell a couple of those properties 5-6 years ago, and they were a great deal. But if you don't know what you're looking at, then you could have got stuck with that.
On this one, do they have any ability to move the bar on you in the agreement as far as what you're held accountable to?
So the question is, do they have the ability of changing anything in the contract? No, we've got a contract that lays everything out exactly in writing what it is up front. And the funny thing is, it's completely negotiable. There's not a set standard for any of them. You can go to different PFCs, public facilities corporations, and they might do a different deal. Yes, sir.
What is the prepayment penalty when you have to cancel these things?
Okay, the prepayment penalty there's not a prepayment penalty on the sale with the PFC. There's just a 1% fee that they charge for the transfer of that. Okay, so there's 1% of the total purchase price that's a fee.
Within 15 years, if we do that.
If you wait 15 years, you cancel the contract, and then you wouldn't have that. The fee will always be there. Well, if you cancel it in 15 years and then you sell it in 17.
Yeah, but I'm saying, let's say the subsequent
Yeah.
buyer
Yeah.
sells it, they will pay.
Yeah. So basically, during the term of the lease, if you sell it, there's a 1% fee to them. But the agreement stays in place for the new buyer, and they don't have to pay property taxes. Okay. And we still do on the debt that we have, we'll have a prepayment defeasance on our loan because it's a Freddie Mac loan. So we will still have a prepayment penalty in there if we pay that off. But after 5 years, there is no prepayment penalty. So we're looking at a 5-year hold is the target. Other questions? Yes, ma'am.
Okay, so the PFC bill that's in front of the house right now is only for new deals, correct? There's nothing with this that will be at risk.
No, this is already going to be done before they even, because it's coming to a vote in September. And so they're trying to get rid of it. Don't know if it's going to pass or not. They're thinking it's probably got a better than average chance of passing because so many of the municipalities don't like it because they get money taken out of their pocket. But the housing departments like it because now they're providing some affordable housing.
But this also has not been the first time it's been tried to be repealed.
Yeah, it's not the first time it's been tried. And so we're actually looking for other properties. Take property taxes out of the equation, good deals become great. I mean, this one, $20 million in equity day one. Holy crap. What's that?
Would not be the favorable K1, right, for the tax standpoint.
Okay, from a tax standpoint, the K1 will not have depreciation on it. So you are paying more because you're making more money on the income or on the sale, et cetera. But at least there's no recapture when we sell. Yeah, double-edged sword. Yes, sir.
Is that 99-year lease at $150,000
Per year.
per year? Can you negotiate that?
That's already been negotiated.
Okay.
That's how we came down to, I think they started off at 250, 2.25, something like that. It got negotiated down. Per year, no escalation. 150,000 per year for 99 years. Right? Am I, if I'm off, I'm not infallible.
Okay. It will be completely known once we get the full
Yeah, we're still in the
memorandum of understanding.
negotiation of this agreement, but that's where it looks like it's pretty much been agreed on right now.
Just some
It just
finer
needs
little
to
details.
define a little point and stamp it and be done. So
What's the final approval? Do you have to go and have, is this voted on somewhere, or is this just behind the scenes?
Is this voted on or behind the scenes?
No,
it's the housing
yeah,
department.
It's the housing authority, Weatherford Housing Authority. Their board will vote to accept that contract, and then the city's bound. The city's already accepted it, so they're bound.
And you got to think, the housing department wants it because they're now, at least they're saying, hey, we're providing affordable housing. The city and county and stuff hate it because they're losing all their tax revenue. So they'll pass it because it's better for them. It's worse for the city, but it's better for them.
Does the city get that $150,000 fee through the housing department, or how?
No, that goes right to the housing department. They don't get anything. So no property taxes in Texas. Can I put my house in that?
Yeah, that would be nice.
Any other questions on this?
When will it actually close with all this going on?
That's part of the challenge we've had, because we've had this under contract for 3 months and it's been going back and forth, and we said we want to do a HUD loan. Now they're doing the PFC and that's going along. Well, now that changes our debt, and so we've got to go back to our lenders and change. So this has been all a juggling act with now this changed, now this changed, now this changed. And so I think we're pretty much set now. Our debt is going to be, well, $57,750,000. I just put 57 million on there. But that could adjust based on interest rates, could go higher or lower. Private equity, I plugged in $10 million. They'll go as high as 15. So we can go ahead and make that determination later, depending on how much capital we raise, what we want to do, et cetera. And the seller's already on board, because a big problem with a buyer, you put it under contract and you've got a drop dead date. You don't close it, they can say, fine, take their earnest money and go on. But they're part of the process of getting this PFC done. So that was one of our discussions, saying they can screw us. They can drag that out past that contract date and say, nope, we're not going to do it. We're going to go do PFC ourselves, and we'll keep the $20 million. But like I said, they've been great to work with. They're extending it out. Right now, I think June 14th, something like that, is our date. Okay, what else? Okay, yes, sir.
Last question. Why are they using the DFW AMI while the property is located in Weatherford?
Why are they using DFW AMI rather than Weatherford? I really have no idea.
I have no idea either, but I'm glad they are.
Yes, yeah, no idea, but I'm glad they are, exactly. When I first heard that, I thought, oh crap, that's going to be pretty low. But no, it's the whole Metroplex. Okay, question for you. Who liked it before at 17%? Who likes it now at over 20% with extremely conservative numbers? Okay, yeah. Yep. So this is a screaming deal. It's absolutely great. It's for accredited only, I'm sorry. But this, and you saw how conservative we were on all the numbers. Just for grins, what if it was just 3.5%? Damn it. That would make a big difference. Which 3.5 is very realistic, okay? Keep trying to touch the screen. Now we're at 26.5. Yeah. Well, what if this was at a 5 cap? Now we're at 31%. I mean, you can just keep crunching, you know, but what we do as sponsors is we got to say, what is the most likely outcome for each one of these assumptions? And you can't change one assumption without knowing that, hey, the PFC, for example. Well, we did that. Well, there's the possibility we can't raise rents as much as we want, so we better adjust that. Or one thing will change and something else, so you've got to adjust all that to have it realistic. You know, like the exit cap rate. Because it's a PFC, it might be a quarter point higher, but that's more than made up for from the extra income. Extra net income. Okay. Yes, ma'am? Can you only have a property with a PFC when you buy it? You can convert existing products to that, yes. And if you're building, if you go into it building for a PFC where you have that agreement beforehand, you don't pay any tax on the products. So there's an 8.25% savings on the cost of construction. Yes, sir.
If, okay, on your sheet there, you did no rent increase for year one.
Yeah.
Is that to keep us at the AMI level, or are we just trying to?
I'm just being conservative.
Okay.
Quite honestly, the real reason I didn't increase it at all is because I didn't want to screw with this computer and only raise it 3%. That's the real reason why I did it right here. On mine in my office, I did use year one at 3%. But here's the thing, it doesn't dramatically change, because if we're over 20%, I don't ever want to go through and say, you know, there's a 30% projected return. That's just crazy. Yes, sir.
Can we convert a Frankfurt to PFC?
Can we convert Frankfurt to a PFC? It's a possibility.
Well, the initial process is the city has to be willing to accept it. City has to get to a point where they feel like they need more affordable housing, so then they would look favorably on an application.
Is the private equity term has changed with PFC on board? As opposed to 13% preferred return, they're gonna get 15%?
No, that hasn't changed. That was the market. I plugged that original number in before we started shopping for the
So 6,
preferred
10,
equity.
7 will be approved.
15%, 8% current pay, 7% accrues.
So it's a 15, not 13.
Yeah, 15% accrues, and then we pay 8%. So 7% is going to accrue, compound and accrue. Here's the thing, spectacular deal, gorgeous property. You should drive out and see it. It is gorgeous. The only improvement we're really going to make is they've got a big area that they were going to, at one time they thought a basketball court, another time they thought a soccer field, and I think we're going to put in a pickleball court. Since I've never played and it seems to be all the rage. You know, I was supposed to play a couple weeks ago, it was too cold. Okay, any other questions? Okay, who wants to get in on this now? Lenny, I'm
Wait a minute,
sorry.
who wants to get in that is not in? That's the, those are the hands I want.
There you go, yeah.
There you go.
So
Come-
definitely
come
talk
see
to
me.
Julian or Garrett, and so that he can get you hooked up. Got to go through the portal and the accreditation and all that other crap.
When do we get this updated pro forma and PFC?
We're still doing the finalizing the details of that. Then I have to get it over to Brian Johnson, who then puts it in a new PPM with all the disclosures, et cetera. And then he has to put on. So I would guess by Monday. It could be as soon as Thursday or Friday, but I would guess Monday.
What was the question?
How soon will we have the PPM?
Okay.
Is that on, by the way? 'Cause
Yeah. Mo, can you give me a little
There we
more
go. There you go.
volume here? Okay, so a couple of things. One, if you go onto the portal, you will not see this property anymore. Today I took it off, okay? And the reason being is because we have people who have already subscribed, and since we are changing, the numbers are going to be changing the PPM, I did not want to mingle the old subscriptions with new subscriptions, okay? So don't worry, just reach out to me, and then I'm going to keep, Garrett and I will keep a different list, so that way we will know who doesn't have to resubscribe, because you will have to, if you're already in, you will have to resubscribe under the new PPM. Okay. Yes, sir. If you're already in, you cannot go bigger, because you want to go bigger? Like real big? She goes, no. He goes, yes. No,
Yes,
you
you
can.
can.
You can. I'm messing with you. You know that. Okay. So it is a Reg D 506C, meaning it is for accredited investors only. So for those of you who don't, and those of you who do know what it is, you'll have to bear with me. Question was asked. An accredited investor is an individual who, if they file individually, have to make $200,000 a year or more for the past 2 consecutive years, with a high probability of making the same amount or more in the year they're looking for accreditation. If they're married filing jointly, or if they're not married and filing jointly, they have to make $300,000 for the previous 2 years and high probability in the current year. Or if you're not going to qualify based on income, you can qualify based on net worth. You have to have $1 million net worth, and that $1 million is calculated all of your assets minus your liabilities, with the exception of the equity in your primary residence.
Does that mean the debt goes against you, but the equity does not?
The debt on your primary residence, let's say you have a $300,000 debt, a $700,000 house. You have to count your debt, but you can't count the equity in your primary residence, okay? So $1 million net worth or more will also qualify you. Another thing, people have asked me, can we just go in, Darwin and I, and form an LLC? Can we go that way? Absolutely you can. Caveat is that every member in the LLC has to also qualify as an accredited investor. So no getting around it.
And there's a qualification that you can go through to do that, but it's a lot easier just to get a letter from your CPA that says you're accredited.
Okay, and let me piggyback on that. For those of you who are accredited and have been, have gone through Verify Investor or through your attorney or your accountant, that accreditation is good for 5 years, and the only burden that you have in any subsequent investment is to provide us with a letter stating that your financial position has not changed. Okay, if it's gone up, great. You can say actually it's gone up, my income or my net worth. However, it cannot have changed and gone down. But you will have to send us a letter stating that your financial position has not changed and therefore your accreditation continues. Any questions on that? Yes, sir.
Yeah, but you said it's good for 5 years?
Yes.
Because I remember it was good for like 3 months or 4 months.
Oh, no, it's good for 5 years. Good for 5 years. Oh, yeah. No, if once you're accredited for 5 years. You can look it up. It's
That letter I got from Verified Investor
Yeah.
said it's good for, it has an expiration date of
from them. But once you're accredited, once you have met all of the criteria, your income or your net worth, it's good for 5 years.
Yes, sir.
Does it include retirement funds?
Retirement funds are fine as well.
Are they? I thought IRA is not included. IRA, 401k.
No, you can use it.
They're included?
It's included.
Okay.
Yeah. Yes, Anna.
So, would be third-party verification?
Third-party verification or your accountant or your attorney.
And the financial situation has not changed in the last 5 years. That is a personal letter or one?
Personal letter. Personal letter. Okay. Yes. Oh, PPM? Yes, yes. Well, right. Once we have the updated PPM, we will absolutely notify everyone who is in our database via a wholesale email blast, and we will also reach out individually to all of those who have subscribed previously. Okay, so don't freak out if you go online and it's not there. Okay, just email Garrett or myself, and we'll take care of it. All right. Any other questions? Yes.
When do you need the money back?
I need it yesterday. Because if I ask for it yesterday, I might get it tomorrow. So, yeah. I mean, it's, if I could count on people to tell me I get it you next week, I'm happy to say next week is fine. But when people tell me next week, it's usually next month or the month after, and yeah. Soon. Okay, any other questions? None? Okay, well, thanks for coming. Yes.
So the unit is gonna show up on a portal for us to look at it?
By next week.
By next week. Yeah. Now, the company agreement, that won't change, right? We're not going to update the company agreement.
The company agreement now.
No.
All right.
It's not closing till June, but it could potentially close in May. Okay. No earlier than May, and I would like to say no later than June, but who knows? Who knows? And part of the slight delay has been that a lot of the players in this whole equation have been out last week on spring break with their kids and this week on spring break with their kids. Kind of like in the holidays, you know, everybody goes away and you know, I got better things to do than play around with the files on in my inbox. All right. Oh, there you go. Who wants the minimum to be 100? Who wants the minimum to be 5,000? Look at all these ends, right? Minimum is 50,000. Well, it's for you who wants to up it up to, you know. Well, there you go. And she's in. Shut up. Don't talk anymore. But with these kind of returns, how do you go wrong? Absolutely. Yeah. But let's not forget now, we've got a fabulous deal called Iron Ranch.
Yep.
I mean, how do you go wrong with Iron Ranch? We'll never do that deal again.
Never do that deal again.
Tell them
That
why.
Iron Ranch, we've got a 25% preferred return, meaning you get paid 25% per year average return before the sponsors make anything. That's insanely
Spoken like a true
stupid.
investor over there.
It was so stupid of me, so stupid of me to go
Yeah,
and do
well, but it wasn't stupid. Actually, it was sharp. In your defense, it was sharp because it was a slight departure from what we normally do. It is a multi-unit property, but it is just not a multi-unit residential property. And so that's why he felt that maybe if I juice the returns, well, not to mention that the deal in general.
The deal is great, yes.
Great, right? But he felt if he juiced the returns, then there would be more interest. But we
Here,
filled
go
it
right
up like that.
So if you had to choose between Iron Ranch and the Mark?
That'd be like grandparents saying, "Which is your favorite grandchild?" They're
Well,
both,
we're pretty
they're both
much
good.
I think
They're
we're
different.
full on Iron Ranch.
Well, we're full up to the point where I haven't received some funds, and I'm getting to the point where if I haven't received your funds, when are we closing roughly on Iron Ranch? Guesstimate.
Probably about 45 days.
45 days. So if I haven't gotten your money by a certain amount, you're out, and I'm going to put the new people on the waiting list in. I don't want to be ugly about it, but I have to have the funds in the bank verified to the lender. Okay? So, answer your question, they're both good. They truly are both good.
Yeah.
Just the difference is one will give you depreciation. It just won't give it to you the year that it's being, well, we closed on the land last year. No depreciation on land. You can only depreciate the improvements, and we won't have really improvements until the end of the year. Right?
Yep, that's correct.
All right. That's pretty much it. Thanks everyone
Yes,
for
thank
coming.
you for coming. Go ahead.
Yep.
For anybody here new,
Yes. Anyone here new?
okay.
Perfect.
Make sure to talk to some of the other people in here that have been around, because we can talk all day long about what we do, how we do it, but you're going to get a better feel by talking to
And
some of
let
the
me
people
put
who
it,
invest with us.
who in here has been investing with us for more than 3 years? Who in here has been investing with us for more than 5 years? Okay, talk to those people, you new people. They'll be able to tell you exactly from their perspective. I'll stand up here and talk about how brilliant he is and how great and wonderful I am, and you know, it means nothing when you talk to those who've been investing and receiving their returns, receiving their reports, and dealing with us on a daily basis. That's when you find out the truth. So speak with them.
Exactly. So thank you all for
Yep,
coming.
thank
Hang
you.
out, talk. It's perfectly fine. Let's do that.